$4,600. That is where gold closed on Monday, January 12, 2026, an all-time record. And while most financial media spent the day debating whether this was a temporary spike or something larger, three of the most powerful institutions on Wall Street quietly released forecasts that should have made front-page news everywhere. HSBC projected gold would reach $5,000 per ounce before June. Goldman Sachs revised their target upward for the third time in 6 months. And Citigroup did something unprecedented in their history as an institution. They issued a $100 price target for silver by March, not December, March. 8 weeks from now. The official explanation from these banks centers on the usual suspects: geopolitical uncertainty, central bank buying, inflation hedging. But here is what none of them are saying publicly, and what their trading desks know with absolute certainty. The physical precious metals market is breaking, not bending, breaking. And the paper price you see on your screen every day is becoming increasingly disconnected from the actual cost of acquiring real metal. On January 2, 2026, the COMEX silver futures contract showed a price of $72 per ounce. That same day, in Tokyo, physical silver was changing hands at $130. In Dubai, the lowest price for a single ounce coin was $99. In Shanghai, buyers were offering $8 to $12 above Western spot prices just to secure delivery. This is not a market functioning normally. This is a confession that two entirely different pricing systems now exist. One made of paper promises, one made of actual metal. And the gap between them is widening by the day. But the divergence in prices is only the surface symptom of something far more significant. To understand why Goldman, Citi, and HSBC are suddenly racing to raise their targets, you need to follow a trail that starts not in the gold vaults of London, but in the overnight funding operations of the Federal Reserve Bank of New York. On December 31, 2025, the Fed executed the largest single-day repo operation in American history. $74.6 billion injected into the banking system through the standing repo facility. Banks posted $31.5 billion in treasury bonds and $43.1 billion in mortgage-backed securities as collateral. This shattered the previous record of $50 billion set just 2 months earlier in October. But this was only the beginning. 5 days before this record injection, on December 26, the day after Christmas, the New York Fed had already pumped $17 billion into an unnamed financial institution. The identity of that borrower remains classified under Federal Reserve disclosure rules and will not be revealed until 20. Someone needed emergency funding badly enough to access the Fed's backstop on a holiday. 2 days later, on December 28th, another $34 billion flowed into the system. Connect these three events. $17 billion on December 20. In less than 1 week, the Federal Reserve provided over $125 billion in emergency liquidity to Wall Street banks. And almost nobody noticed because Americans were focused on the holidays. What came next changed everything. On December 11th, the Fed had quietly removed the $500 billion cap on its standing repo facility. The official language called it operational flexibility. What it actually meant was unlimited emergency lending with no ceiling. They even renamed the facility to reduce what internal memos described as stigma, the fear banks have of being seen accessing emergency funds. This was not coincidence. This was preparation. The question that matters is why. Bank reserves had already fallen to their lowest levels since the secured overnight financing rate had breached the Fed's target range in October. Liquidity was tight long before December arrived. Something else was driving this demand for emergency cap. The answer becomes clear when you look at what happened in the silver market during the exact same period. On December 29, 2025, spot silver hit an all-time high of $84. This capped a year in which silver gained 143%, its best performance since 19. Gold rose 63% over the same period. But unlike gold, the silver market is structurally different. It is smaller. It is more levered. And it is controlled by a handful of institutions whose short positions have become increasingly difficult to manage. The Chicago Mercantile Exchange responded with emergency measures. On January 7, 2026, they raised margin requirements to $32,500 per contract, a 47% increase in a single week. The official explanation cited volatility management. The actual effect was to force leveraged traders out of the market. When margin requirements increase, paper traders must post more collateral to maintain position. Many cannot afford this, so they liquidate. This creates artificial selling pressure that pushes down the paper price while doing nothing to address the underlying physical shortage. The traders dumping their COMEX contracts are not selling actual metal. They never owned any metal in the first place. This is the mechanism that has allowed the paper price to remain suppressed, even as physical premiums explode across Asia and the Middle East, and the evidence of this suppression is now undeniable. COMEX registered silver inventory has collapsed by more than 70% since 20. The ratio of paper contracts to physical ounces has reached 356 to 1. For every ounce of real silver backing the futures market, there are 356 ounces of paper promises. The math does not work. The Silver Institute reported a structural deficit of 148.9 million ounces in 20. Over 4 years, cumulative deficits reached 678 million ounces. This is not a temporary imbalance. This is a market running on borrowed metal and borrowed time. And then China made its move. On January 1, 2026, the Chinese Ministry of Commerce implemented new export controls on silver, a licensing framework restricting exports to only 44 government-approved companies meeting strict criteria, including minimum production of 80 tons annually and credit lines of $30 million. Smaller refiners and traders are now locked out of the international market. China is the world's second-largest silver producer and dominant force in global refining, shipping over 4,600 tons abroad in the first 11 months of 20. These restrictions effectively remove 60 to 70% of Chinese silver supply from Western market. The timing was deliberate. Beijing announced these measures in October, the same day President Trump met with President Xi in South Korea, but the implementation date of January 1, 2020. Within days of restrictions taking effect, Chinese companies began contacting silver miners directly. One Canadian mining company reported receiving offers from 2 separate Chinese buyers willing to pay $8 above spot price for immediate delivery. An Indian buyer offered $10 above spot. This is desperation buying from industrial consumers who can see what is coming. Silver is not just a precious metal, it is a critical industrial input for technologies. Governments have declared essential. Solar panels require silver paste. Electric vehicles use silver in batteries. AI semiconductors depend on silver's unique conductive properties. In November 2025, the United States added silver to its critical minerals list. There is no substitute for silver in high-efficiency applications, and demand is accelerating while supply remains constrained. The solar industry alone consumed over 170 million ounces of silver in 20. Electric vehicle production continues expanding globally. Data centers powering artificial intelligence systems use silver in their cooling systems and electronic components. Every trend driving the modern economy increases silver demand, and the supply side cannot respond. Global mine production grows at just 1 to 2% annually. Major producers face declining ore grades. New mining projects take a decade to develop. Even at $94 per ounce, the highest prices in history, supply response will take years to materialize. This is why Citigroup issued their $100 price target for March. When demand exceeds supply by hundreds of millions of ounces annually, and the largest refining nation restricts exports, prices must adjust. The only question is how quickly. But silver is only half the story. When gold broke through $4,600 on January 12th, the catalyst was a revelation that Federal Reserve Chairman Jerome Powell had been threatened with criminal indictment by the Trump administration. The stated reason involved a building renovation project. The actual motivation, according to Powell himself, was to gain control over interest rate policy. This struck at the foundation of modern central banking independence. Within hours, a dozen global central bank governors issued an extraordinary statement of solidarity with Powell and the Federal Reserve. Markets interpreted this as confirmation that the threat was real and serious. Gold responded the way it always responds to institutional uncertainty. It went up. But the deeper driver extends beyond any single political event. Central banks around the world have been accumulating gold at the fastest pace in decades. Official sector purchases reached 700 tons in 2020. For the first time since Bretton Woods ended, the market value of gold held by foreign central banks has overtaken their holdings of U.S. Treasury securities. This is a structural shift in how the global financial system stores wealth. Global debt has reached $346 trillion, equivalent to 310% of global GDP. The United States adds $2 trillion to its debt every year. Interest payments exceeded $1.2 trillion in 2025, consuming more of the federal budget than defense spending. The purchasing power of fiat currencies erodes with every quarter while gold maintains its value across centuries. HSBC's forecast of $5,000 gold reflects these structural realities, but they also warn of sharp volatility, sudden reversals, and wider trading ranges as the market adjusts. The first COMEX delivery report of 2020, JPMorgan aggressively stood for maximum physical delivery. This represents a complete strategic reversal, For years, major bullion banks maintained large short positions in silver futures, profiting when prices fell. Now the largest player in the market is demanding actual metal. Reports suggest JPMorgan has accumulated over 750 million ounces of physical silver, the largest stockpile in the world. They have allegedly closed their entire 200 million ounce short position and flipped to massive net long. When the institution with the deepest pockets decides to accumulate physical inventory rather than paper positions, it sends a signal that cannot be ignored. They expect the paper market to fail. Other banks are not so fortunate. In Rajkot, India, 44 silver trading firms declared insolvency, with combined liabilities approaching $425 million. These were established trading houses that bet on paper price suppression continuing. When the CME raised margins, they were wiped out and out. This is what happens when paper positions meet physical reality. Consider the math. Silver at $94 today, Citi says 100 by March. That is 6% over 8 weeks. Given that silver moved 27% in December alone, this is almost cautious. Gold at 4,600, HSBC says 5,000 by June, 8.7% over 5 months. Gold gained 63% in 2020. These are linear extrapolations of existing trends assuming no acceleration. The risks are asymmetric to the upside. A banking crisis, a geopolitical shock, or a breakdown in COMEX delivery could send prices dramatically higher than these targets. According to the World Gold Council, institutional investors held just 1 to 2% of portfolios in gold at year-end. If allocations increased to 5%, additional buying would be measured in hundreds of billions. There is not enough physical metal available to absorb this demand at current prices. The convergence of forces is now undeniable. Fed liquidity injections at emergency levels. China restricting silver exports as industrial demand accelerates. COMEX inventories collapsed to levels that make physical delivery increasingly difficult. Physical premiums in Asia demonstrating the paper price no longer reflects reality. Major banks raising targets while accumulating physical positions. The largest player has reversed from short to long. At some point, paper price must converge with physical reality. Either physical premiums collapse, which requires supply that does not exist, or paper price rises to meet physical. Goldman, Citi, and HSBC are betting on the latter. $5,000 gold, $100 silver. Not someday. Not eventually. In the first half of 2020, the next chapter will be written in the delivery reports from COMEX, the inventory data from Shanghai, the emergency operations of the Federal Reserve, and the price quotes from physical dealers around the world. The vaults are draining. The premiums are widening. The banks are positioned, and the clock is ticking toward a reckoning decades in the making. Watch the data, follow the money, and remember that in a world where paper promises multiply without limit, only what you can hold in your hand retains its value across time.